Welcome to News Nexus, your hub for uncovering global financial mysteries and deep economic insights. Today, we journey to a small island nation in the North Atlantic that once sent shockwaves through the global economy, Iceland. A land of fire and ice, famous for its breathtaking landscapes, strong community ties, and Viking heritage. But in 2008, Iceland captured the world's attention for a very different reason. Practically overnight, its banking system collapsed. The world watched in disbelief, but what really happened? And could it happen again? Let's uncover the full story. Before 2008, Iceland was celebrated as a modern economic miracle. A nation of just 320,000 people, it had transformed from a fishing-based economy into a global financial hub. A success story that economists around the world admired. In the 1990s, Iceland liberalized its financial system, privatized its banks, and deregulated its economy. By the early 2000s, its three major banks, Kaupthing, Landsbanki, and Glitnir, were offering aggressive financial products not only in Iceland but across Europe. The country boasted one of the highest GDP per capita figures in the world. Unemployment was low, the stock market was booming, and Icelandic banks were borrowing heavily from international lenders while investing in global assets. On the surface, it looked like nothing could go wrong. But how did three small banks from a remote island suddenly evolve into international financial giants? The answer lies in their strategy: borrow money abroad at low interest rates and invest in high-yield assets. Icelandic banks also expanded aggressively into foreign markets, especially in the UK and the Netherlands. They offered high-interest savings accounts to European depositors, promising returns far better than traditional banks. This model, known as the carry trade, worked like magic in the short term. The banks grew at an astonishing pace, and so did the fortunes of Iceland's elite. Reykjavik became a playground for young, ambitious financiers who were soon nicknamed the Viking Raiders by British media. But beneath the surface, the system was dangerously fragile. Despite outward confidence, economists and regulators began to worry. Iceland's banks had grown so large that their combined assets were nearly 10 times the size of the country's entire GDP, a glaring imbalance. International credit rating agencies started to sound the alarm. Yet the Central Bank of Iceland and the Financial Supervisory Authority were too small and too inexperienced to regulate these rapidly expanding institutions. Despite these warnings, optimism remained high. Icelandic bankers dismissed the concerns, and the government stood by them, believing in the unstoppable momentum of global finance. But in 2008, the unthinkable happened. The US subprime mortgage crisis triggered a worldwide credit crunch. Banks across the globe tightened lending, and Iceland's banks, highly leveraged and heavily dependent on foreign loans, suddenly found themselves isolated. As their debts matured, refinancing became impossible. Foreign money dried up. Investors lost confidence. Depositors, especially those abroad, began pulling out their funds in massive numbers. In October 2008, within the span of just 1 week, all three of Iceland's major banks, Kaupthing, Landsbanki and Glitnir, collapsed. The country's stock exchange lost 90% of its value. Inflation soared. The Icelandic krona lost more than half of its value. The government declared a state of emergency. Prime Minister Geir Haarde addressed the nation with a now famous statement: "God bless Iceland." Faced with an unprecedented financial disaster, Iceland did something few expected. It let its banks fail. Unlike the United States and the United Kingdom, which used public funds to bail out their financial institutions, Iceland took the bold step of nationalizing the failed banks, ring-fencing domestic operations, and separating them from their foreign debts. The International Monetary Fund stepped in with a $2.1 billion loan, and Iceland imposed strict capital controls to stabilize its economy. But the aftermath wasn't just economic. Ordinary Icelanders watched their savings evaporate, their pensions shrink, and unemployment soar. Public anger reached a boiling point, and the government fell in early 2009. One of the most unusual chapters in this story was Iceland's commitment to accountability. Unlike other nations, Iceland didn't just bail out its banks, it held people responsible. Top banking executives were prosecuted and jailed for fraud, market manipulation, and abuse of power. The Special Prosecutor's Office launched more than 200 investigations, resulting in over 20 convictions. Iceland became one of the few countries where bankers faced legal consequences for their roles in the financial collapse. For some citizens, this was a long-awaited form of justice. For others, it raised questions about whether the right people had been held accountable, or whether they were simply convenient scapegoats. Despite the scale of the disaster, Iceland surprised the world with how quickly it recovered. Capital controls, a sharply weakened currency, and strong export sectors, particularly tourism and fishing, helped the economy rebound by 2011. The government also overhauled its financial regulatory framework, learning hard lessons from its past mistakes. Iceland's approach was even praised by leading economists like Paul Krugman, who suggested that sometimes letting banks fail is better than saving them at the taxpayer's expense. But while the economy stabilized, deep scars remained. Public trust in both banks and politicians was severely damaged, and the effects of the collapse are still felt today. So what lessons can the world learn from the Icelandic financial collapse? First, size matters. Iceland's banks had grown far too large for the economy to sustain. A valuable lesson for any small nation seeking a place in global finance. Second, regulation is critical. Deregulation without proper oversight opens the door to unchecked risk and reckless behavior. Third, sometimes the best bailout is no bailout. Allowing market corrections, enforcing accountability, and letting institutions fail can lead to a healthier recovery. And finally, no economy, no matter how small or remote, is immune from the shocks of a global financial system. Today, Iceland stands as a more resilient economy. Its financial system is smaller, more cautious, and more tightly supervised. The mystery behind its collapse wasn't about luck or bad timing. It was a perfect storm of ambition, deregulation, global exposure, and ignored warnings. Could the Icelandic story happen again in another country? History suggests the answer is yes. Tell us what you think in the comments. Don't forget to like, share, and subscribe for more deep dive stories right here on News Nexus. Until next time, stay curious, stay informed.